Hey guys, this is the Trading for Dummies series brought to you by Mastermind Trading. Introduction. In this video, we'll be discussing multiple time frame analysis and how it is used by traders in an attempt to search the market for opportunities. Now, this video is particularly important because understanding of this concept is going to make understanding of further concepts easier as we move forward. Multiple time frame analysis basically is an approach by traders to interpret market information across multiple time frames in an attempt to make better decision in the market. We earlier defined candlestick as a representation of price movement over a given period of time across these 4 points of open, close, high and low. Now if we open up a candlestick, it is going to look very much likely to the diagram on the right hand side. Let's take for example that we have in this case a 4 hours candlestick in which in the first hour prices open up slightly high, going a bit lower, then high, and then closing slightly lower. Now this is the ideal movement of a bullish candlestick. If you are to look at it on the 4-hour time frame, what you see is one 4-hour bullish candle. Meanwhile, on the 1-hour time frame, you would see 4 1-hour either bullish or bearish candle moving in a particular pattern. So the market turns from one time frame to another, and it is that concept we want to look at today, mostly in illustrative form. But if you understand what we want to talk about today, this can greatly change your understanding of everything else going forward. Similarly, the same is applicable when looking at market structure. We as traders are made to believe that the market basically moves in trends of up and down from swing points of highs and lows basically. Now, as simple as this may sound, you would notice that when you open this up on a price chart, you don't just find price moving in a straight line in impulse and then correction and then continuing in the direction of that trend. What you find in your price chart is market moving in bits of downtrend and bits of uptrend across different time frame, in a way that is possible for you to even be able to identify maybe a smaller time frame downtrend in an overall uptrend. This concept is referred to as the fractal nature of the market and aims to look at market movement across multiple time frames. Let's take the black line on the diagram to represent the bullish trend on a bigger time frame, and then the red line to represent the same bullish trend on a smaller time frame. Now you would notice that while on the bigger time frame it looks more like a straight impulse and then a correction and then a continuation of the uptrend. Now on the smaller time frame, while you can still find the bull trend inherent, you can see that this is not without these small pullbacks and continuation and pullbacks and all of that. This is better illustrated in this diagram, where on the first image above there, which represents the 4 hours chart, what you can find is a straight uptrend of higher highs and higher lows and higher highs and higher lows before reversing to a downtrend. Now that's a clear trend. Anybody can see that. Now coming down to the 60-minute chart, you will still find that uptrend prevalent. We are still in an uptrend, but this is not without this smaller downtrends and then smaller uptrends and then smaller downtrend, and then going even further to the 15 minutes, you're going to still find more of that, this small impulse, small correction, small impulse, small correction. Now one thing this tells for sure is this: bigger time frame trends are always the most prevailing trend. It doesn't really matter what's going on in smaller time frame. At the end of the day, it is expected to go in the direction of the bigger time frame trend. And this also shows how market moves from smaller time frame to bigger time frame, forming structures across every time frame. Now, the fact that a bigger time frame bias is bullish doesn't necessarily mean that you can't have a smaller time frame bearish bias. It basically just boils down to where you're looking at the market from. There are two ways that traders look to use multiple time frame analysis. The first is called top-down analysis, which is basically an approach of traders looking at the market from bigger time frames down to smaller time frames, and then down to smaller time frames, and then down to smaller time frames until they get a preferred entry. The trader looks to form an overall directional bias from bigger time frame, while looking to enter the trade on smaller time frame, while looking to catch precise entry on smaller time frame. Now, the reverse of that is where you find traders looking at the market from smaller time frame all the way back up to bigger time frame. Although ideally, for best practice, I think it is better to look at to form an overall directional bias on bigger time frame while looking for entries on smaller time frame. So guys, that is it with multiple time frame analysis. That's it with this video. I remain Monaco Daniel, the mastermind trader from the world most populous black nation.